You're listening to the Learn Like a CPA podcast, where we talk about all things real estate, tax strategy, and personal finance. Whether you're a real estate investor looking to scale your portfolio, or you're an individual wanting to take your financial freedom journey to the next level, this is a podcast for you. Welcome back to the show. Today we're going to be taking some Q&A. We're going to be talking about bookkeeping preferences. We're going to be talking about how taxes work in a self-directed IRA account and how they work in general. We're going to be talking about accelerating depreciation if you're a non-real estate professional. And we're also going to be talking about and doing a comparison between a 15-year and a 30-year fixed rate mortgage. So to start off, one of the questions was if I had any bookkeeping preferences for rental properties and also some do's and don'ts. So I would say if you're not planning on hiring a bookkeeper and you're going to DIY, I prefer Stessa for bookkeeping. Stessa is, first of all, it's free. It's also customizable to landlords, whereas QuickBooks is more for general business. You can do your rental properties under QuickBooks. It's just Stessa has a lot more features in there that QuickBooks does not. However, I would say if you have five plus properties, it's worth hiring a bookkeeper. You'll save so much time and energy and not having to go back and look through your financials and not have to worry about whether or not you recorded expenses or not. So if you have more than 5 properties, it's going to be worth having a bookkeeper. I would also say if you're in a partnership with somebody else, a joint venture, have a bookkeeper. Don't try to DIY the accounting yourself because there's so much more that's involved when you own a property with somebody else, when you're partners with somebody else, than it is if you just own it by yourself. So if you're going to have more than 5 properties, I would recommend a bookkeeper. If you're going to partner with somebody to own a property, I would also hire a bookkeeper because odds are you're going to be preparing a partnership tax return, and those returns get very complicated quick, and you're going to want an accurate set of financial statements. Next off, in Stessa, you can actually link your bank account or your credit card to the Stessa account. So that way, anytime you swipe that card for a rental purchase, supplies, expenses, maintenance, it will automatically track in Stessa and it'll categorize the transaction for you. And you don't even have to go in and do that. And you just simply review. So once it takes a little bit, but Stessa will start to pretty much learn your actions, and then it'll start classifying the categories for you. Another tip would be to reconcile your books monthly. Do not wait until the end of the year or after the year's over in order to get your books in order. If putting in 30 minutes to maybe an hour every single month as opposed to putting in 12 hours at the end of the year is going to feel a lot better, and you're going to have a more accurate set of financial statements that way. Because just think about it. Would I rather put in an hour each month for 12 months or put in 12 hours at the end of the year? It's going to be the 12 hours plus more time because you're going to spend so much time backtracking and figuring out which expense you put in, which one you didn't. So it's best to reconcile your books monthly or at least on a reoccurring schedule. For large CapEx expenses that you make, so you might have large repairs or maybe you buy large furniture, you're going to have to make sure you classify the asset properly in Stessa. So most assets either have a 5, 7, 15, or 27.5 or 30-year life, depending on the property. So, and this is important because when you have large expenses, you oftentimes have to depreciate those expenses, and you're going to want to know, you and your accountant are going to want to know the class life of that asset. So those are the things that I have for bookkeeping. It's really about just being ahead of the game and keeping track of your expenses on a monthly basis rather than having to backtrack and go back in time and try to figure them out. It's way more simple if you do it up front and you spend the time doing it rather than kind of backtracking. Next thing, one of the questions was, how do taxes work in a self-directed IRA when I take on debt to purchase properties? So the way that works is when you have a self-directed IRA, you're using tax advantage money to invest in real estate, whether that you use maybe you had traditional IRA or you had a Roth IRA that you self-directed. Either way, you're using your tax advantage money for your retirement account. Now, when you have a self-directed IRA, most people, they don't have $300,000-$400,000 in their IRA account from the start to be able to buy a property, so they have to take out a loan. And you can get loans to your IRA account when you buy a property. However, the loan has to be what is called non-recourse debt. And when you borrow non-recourse debt in an IRA account, you're subject to something called UDFI, which can potentially be a tax on unrelated debt finance income is what it's called. The tax is based on the amount of debt that's taken on from the property. And it's taxed at trust and estate rates, which are awful. They're very high tax rates. So you want to try to steer clear of UDFI if you can. But to kind of break it down, if I had an IRA account that had, let's say, $100,000. So my IRA account has $100K in it, and I want to go and buy a $300,000 property. I'm going to have to get debt financing, right, of $200,000. Well, this debt financing is UDFI, and it's a non-recourse debt. So let's say this property goes and makes maybe $10,000 that year. I'm subject to taxes on the portion that's earned through debt financing. So if I took this, of the $300,000 purchase price, I take $200,000 divided by $300,000 total, and it'd be about 66%. So 66% of this $10,000 is going to be subject to UDFI tax, and that's how most rentals, most IRAs are going to have enough depreciation. If they're long-term rentals, they're going to have enough depreciation to kind of cover the cash flow. So you'll be safe for a while when it comes to UDFI, but you might have to run into this. And in that case, you'd have to file a tax return in order to pay the UDFI tax. Again, it's on the portion that you use as leverage. It's not the entire thing, but it's a tax on the portion that you use as leverage. A pro tip is that you can actually self-direct your solo 401k, and solo 401ks are not subject to UDFI. So there's a rule in there where basically 401ks are not subject to UDFI, which I find pretty cool. So if you have a 401k that's self-directed, you don't have to worry about UDFI like you would if it was an IRA or an HSA. Well, the next question I had was, should you accelerate depreciation if you're a non-real estate professional? And just to kind of give you a backtrack, the reason why you want to accelerate the depreciation is to speed up your deductions in the current year rather than taking them down the road. Because when you buy a property, you think of it as like a tax savings piggy bank that you have, and it's either stretched out over 27 and a half years if it's a long-term rental, or 39 years if it's a short-term rental. Accelerating the depreciation speeds that up. So instead of getting the tax benefit for, let's say, 27 and a half years, you can speed the majority of that up in the first few years rather than 27 and a half years. When you accelerate the depreciation, you're pushing the deductions up to the current year rather than delaying them. It really depends. I think it's based on how much taxable rental income do you have that year, right? So if you're not a real estate professional, the losses that you generate from the depreciation, you're not even going to be able to use those to offset any of your income. You're only going to be able to use those to offset rental income if you have it. So let's say you had 2 or 3 properties and they're cash flowing really well, and then you buy a 4th property. Hey, maybe you do want to accelerate the depreciation on that one because you could actually use it to offset the first 2 or 3 properties. Another question I'd ask is, what is your tax bracket? And this is one I bring up a lot with clients is, if you're in a 12 or 22% tax bracket this year and you just bought a rental property and you're looking to accelerate the depreciation on it, it may make sense to want to delay that, to not want to accelerate the depreciation, because think about it, next year, once you have a full year worth of cash flowing rental properties, you're probably going to be pushed into a higher tax bracket, maybe 24, 32. You might be pushed in a higher tax bracket. So it may make sense to not want to delay the delay the appreciation, because the time value of money, you're going to save more by delaying it rather than taking it in the current year. It also depends on the amount of properties that you plan on buying. If you're in between accelerating the depreciation, but you're going to plan on buying more properties in the future, well, maybe you can accelerate the depreciation on the future properties rather than this one. again, it depends on your income, it depends on your tax bracket, it depends on your investing goals and your future. And so that there's not really a catch-all answer, and it really depends on your situation. And you should sit down with a tax advisor to have them walk you through the different scenarios. The fourth topic today is going to be the difference between a 15 and a 30-year mortgage on a primary residence. So this is pretty much an age-old argument of, should I take out a 15-year mortgage and speed it up, and that way I have more equity in the property, or should I take out a 30-year mortgage and make payments on it, but invest the difference between the 15-year and the 30-year payment? So I'll preface this with saying that it's really an emotional decision as much as it is a logical or a math decision on whether or not you want to pay off your mortgage early, or you want to just do the 30-year mortgage and invest the difference. On average, typically people are in a house between 7 to 8 years before they either sell that house or refinance their mortgage. So keep that in mind when you're thinking about this decision, because on average people only stay in their primary residence for 7 to 8 years. But I kind of broke down the numbers a little bit because, like I said, it's also a budgeting and a financial decision too, right? Because if you're like, hey, I want to do a 15-year mortgage because that means I'll be able to pay off my house early, I'll be able to free up more money in the future, I'm building equity more sooner. You're gonna have a way higher monthly payment with a 15-year mortgage than you are a 30-year mortgage. So the argument is, okay, well, my 15-year mortgage, or do I do a 30-year mortgage and a lower payment, invest the difference? And the numbers on a $300,000 loan, if you take out on a 15-year mortgage at a 3% interest rate, your monthly payment is going to be $2,071. Okay, compared to if you took out a $300,000 loan at a 3.5% interest rate, your monthly payment is going to be $1,347. So about a $700 difference between the monthly payments. And the argument is, if you take that $724 a month, if you were to do a 30-year mortgage and invest it at 10%, what do the numbers come out to be? So a 15-year mortgage, you're going to have a higher monthly payment, $700 more. Can your budget actually substantiate that, right? Can you actually afford to have a $2,000 mortgage payment? That's something you got to ask yourself, right? If you're going to go the 15-year route. The 30-year route only has a $1,300 mortgage payment compared to the $2,000 mortgage payment of the 15-year. So then you take that difference, that's $724 difference, and you say, hey, I'm going to do the 30-year mortgage. I'm going to take the difference between the 30 and the 15. I'm going to invest it, and it's going to earn, let's just say 10% a year. Well, $724 a month for 30 years at a 10% rate of return equals $1.4 million after 30 years. So that decision to take out a 30-year mortgage, invest the difference between the 30 and the 15, amounts to be about $1.4 million over 30 years. Obviously, everybody can tell that this mathematically makes sense, but does it make sense emotionally, logically, financially in your own household? It depends on your situation. Another thing too is the interest difference. If you do the 30-year loan, you're paying an extra $112,000 in interest over the course of that loan compared to the 15-year. And then, of course, you can do the math on, well, what would happen if I saved on that interest and took that interest money and invested it instead? So there's tons of ways you can analyze it. Obviously, from a financial, if you're analyzing the numbers, most of the time people are going to tell you it makes a lot more sense to do the 30-year and just take what the difference in the payment is and invest it in the market. Well, you have to be disciplined enough to actually take that money, that $700 difference, and invest in the market. If people want to make the 15 versus the 30-year mortgage argument, but they actually don't invest the difference, then we're back at square one, and there's really nothing to argue about. But from a math standpoint, you will come out much more ahead by doing a 30-year mortgage, taking the difference between the 30 and the 15, and investing that, and taking that and investing it you'll come out more ahead. So from a financial standpoint, the numbers are going to make sense, but from an emotional standpoint and a logic, and it depends on your family situation, there's a lot of factors at play. So again, it's really a personal finance decision. It's not a one size fits all. And you should really run the numbers for yourself before you go to buy your first home. Hey, do I want to do a 30-year mortgage, do a 15? The 15, obviously you're going to pay off your mortgage a lot quicker, but you might be losing out on purchasing power if you could have that money invested in the market or elsewhere rather than your personal residence. Versus the 30-year, obviously you're building equity a little bit slower. However, in your house, you're building equity in the stock market, and your money is going to appreciate more in the stock market than it will in your primary residence. So that's it for today's show. We covered so much today. We covered bookkeeping. We covered self-directed IRAs. We covered accelerating depreciation. We covered the difference between a 15 and a 30-year mortgage. Covered so much today. If you liked today's episode, make sure you leave a review on Apple and Spotify. And let me know if you have any questions. You can hit me up on Instagram at LearnLikeACPA. I'm also on Twitter. And I'll see you guys on the next episode.